There is a moment that every founder remembers. Not the moment they almost went bankrupt, not the moment a deal fell through, the moment they looked at their best month of sales ever, looked at their bank account, and saw almost nothing there. It doesn't make sense at first. It shouldn't be possible. You just made more money than you've ever made. The numbers say you're winning, but something deeper, something the numbers don't show, has quietly been pulling the floor out from underneath you. This is the story of how a business can double its revenue and run out of cash. And the reason it matters isn't just because it's counterintuitive. It's because it happens constantly to capable people running real businesses, and most of them don't see it coming until it's too late. To understand why, you have to start with a question. Almost no one asks, what is revenue actually? Most people treat revenue as money. If a business says it made $5 million last year, the instinct is to picture $5 million sitting somewhere, in an account, in a safe, somewhere real. But that's not what revenue is. Revenue is a record of what was earned, not what was received. It's a number on a document, not a balance in an account. And in the world of business accounting, those two things can be separated by weeks, months, or sometimes an entire season. When a company ships a product or delivers a service, it records that transaction as revenue. That's the rule. Not when the customer pays, not when the cash arrives, when the work is done. So the moment an order goes out the door, the revenue counter goes up, and the bank account doesn't move at all. This distinction, the one between when revenue is recorded and when cash actually arrives, is where the trap begins. And it gets much more serious once a business starts to grow. Imagine a manufacturing company, not a massive one, a mid-size operation that makes components for industrial clients. For years, they ran at a steady pace, 20 million in annual revenue, reliable customers, predictable cash flow. Then something changed. They won a major contract, then another. Within 18 months, their order book doubled. Revenue projections went from 20 million to 40 million. The team celebrated. The founder breathed a little easier. The business was growing. But here's what was also happening underneath that growth. To fulfill twice as many orders, they needed twice as much raw material. That material had to be purchased before a single unit was shipped. Suppliers don't wait, so cash went out. Then they needed more labor, more shifts, more machinery, more cash out. Then the orders went out the door. Revenue went up. But their biggest customers, industrial companies, distributors, institutional buyers, paid on 60 or 90-day terms, meaning the company shipped $40 million worth of product and received almost none of that cash for months. The business was producing at full speed. Revenue was real, but the bank account was running toward empty. This is what finance professionals call a cash flow crisis. And more specifically, it's the result of a concept known as the cash conversion cycle. The cash conversion cycle measures the time between when a business spends money to produce something and when it receives cash from selling it. In simple terms, how long is your money tied up before it comes back? For a business with a 30-day cycle, it's manageable. For a business with a 90-day cycle, fast growth becomes a serious problem. Every new order means more cash tied up for longer. The faster you grow, the more cash you need just to sustain the growth. Before a single dollar of new revenue comes back in, the mechanism works like this. You spend $100,000 on materials in January. You produce the product and ship it in February. You invoice the customer in February. The customer pays in May. For 4 months, that $100,000 is sitting somewhere between your warehouse and your customer's accounts, payable department. It isn't available to you. It isn't in your account. And if you're growing, if you needed to spend $200,000 in February and $400,000 in March, that gap between money out and money in becomes a chasm. This is why growth, the thing every business is supposed to want, can become the thing that kills it. What makes this especially difficult is that the financial documents most business owners look at every day don't reveal it clearly. The income statement, what most people call the P&L, shows revenue and expenses. If revenue is higher than expenses, the business looks profitable. A profitable business seems healthy. But profit and cash are not the same thing, and the income statement doesn't tell you when cash actually moves. The document that shows cash reality is the cash flow statement. It tracks money in and money out in real time. Not when revenue is recorded, but when it's received. Not when an expense is incurred, but when it's paid. Most small and medium business owners look at the income statement constantly and look at the cash flow statement almost never. And that asymmetry between the visibility of profit and the invisibility of cash is exactly where the trap hides. There's a phrase that accountants use: a business can be profitable and insolvent at the same time. Profitable means your revenues exceed your expenses on paper. Insolvent means you don't have cash when a payment is due. You can be both simultaneously. A business that earns $40 million in revenue but collects most of it 3 months late while paying its suppliers and employees every 30 days can be profitable on every financial report and still miss payroll. The businesses most exposed to this are the ones operating in what's called B2B, business to business, where transactions happen between companies rather than directly with consumers. When you buy a coffee, you pay immediately. When a distributor buys 10,000 units of an industrial product, they don't pay immediately. They pay on terms. Net 30, net 60, net 90. These are standard commercial arrangements that companies negotiate with each other, and they're perfectly normal. But they create a structural gap that becomes a structural risk the moment volume increases quickly. A business that does $5 million in revenue with 60-day payment terms has a certain amount of cash locked up in outstanding invoices at any given moment. If that business doubles to $10 million in revenue with the same payment terms, the same cycle, it now has twice as much cash locked up in outstanding invoices. It needs twice as much working capital just to operate at the same level, and if it didn't have a surplus of cash before that growth, it may find itself unable to fund the growth at all, even though the revenue is real. This isn't a hypothetical. It's a well-documented pattern that has ended companies that had every reason to survive. Retail chains that expanded too quickly found themselves in this exact position. They had revenue. They had customers. They had full shelves. What they didn't have was the cash to pay their suppliers for the inventory while they waited for customer payments to cycle through. When the credit lines that were bridging that gap got pulled or ran out, the business collapsed, not because the model was wrong, but because the cash conversion math was never solved. The same pattern appeared in the supplier networks during periods of rapid industrial expansion. Companies that won large government or institutional contracts sometimes couldn't survive long enough to collect on them. They'd win a contract worth more than their previous 3 years of revenue combined, spend everything they had to fulfill it, and then wait 90 days, 120 days, for payment that eventually came to the obligations that were already due. What's striking about these situations is that they weren't caused by fraud, by mismanagement in the obvious sense, or by bad strategy. They were caused by a misunderstanding of what a financial number actually represents. Revenue is a claim on future cash. It is not cash itself. And the claim, no matter how legitimate, no matter how large, doesn't pay a supplier invoice that's due today. There's a psychological dimension to this that matters too. Growth is visible. Revenue milestones get announced. Teams celebrate. Investors applaud. The press covers the revenue number because it's simple, dramatic, and easy to headline. Nobody writes a story about a company improving its days, sales outstanding by 12%. Nobody throws a party because the cash conversion cycle shortened. These are the metrics that actually determine whether a growing business survives, and they are almost entirely invisible to the outside world and often to the people running the company. This invisibility creates a specific kind of danger. When a company hits a revenue milestone, the internal feeling is one of success. That feeling is real and the milestone is real. But the feeling doesn't distinguish between revenue that has been collected and revenue that's still outstanding. And when decisions are made based on that feeling, hiring more people, taking on more orders, expanding operations, those decisions consume cash that hasn't arrived yet. The company spends against a future that exists on paper but not in the bank. The businesses that survive rapid growth understand something specific. Working capital is not just a line on a balance sheet. It's the oxygen that a growing business breathes. It's the gap between what's owed to you and what you owe to others. And managing that gap is as important as managing revenue, maybe more important, because when revenue is strong and working capital runs out, you don't get a warning, you get a payment you can't make. There are tools designed to manage this. Invoice factoring allows a business to sell its outstanding receivables to a financing company at a small discount, converting future cash into present cash. Asset-based lending uses the value of receivables and inventory as collateral for credit lines that can bridge the gap. Supply chain financing allows suppliers to get paid faster through third-party arrangements without affecting the buyer's payment schedule. These are legitimate instruments, and well-run companies use them routinely, but they require planning, lead time, and often a clear financial track record. They are not emergency solutions you can call on the morning you realize you can't make payroll. The businesses that don't survive this trap are usually the ones that either didn't see it coming or saw it too late to respond. Sometimes the warning signs were there: cash flow statements showing negative trends, receivables aging beyond their stated terms, a growing gap between revenue growth and bank balance, but they were ignored in favor of the more visible revenue metrics. By the time the crisis became undeniable, the options had narrowed to nothing. What does survival look like? It doesn't always mean having more revenue. Sometimes it means growing more slowly, deliberately, strategically, to stay within a cash envelope the business sustain. It means negotiating payment terms aggressively on both sides, asking customers to pay faster, asking suppliers to wait longer, and closing the gap wherever possible. It means treating the cash flow statement as a primary document, not an afterthought. And it means understanding that every new order, every new contract, every revenue milestone carries a cash cost that has to be funded before the revenue arrives. There's a phrase that circulates in financial circles, usually attributed to venture investors and turnaround specialists. Revenue is vanity, profit is sanity, cash is reality. It sounds like a slogan, but the logic underneath it is precise. Revenue tells you what a business earned. Profit tells you what it kept after expenses. Cash tells you whether it can function tomorrow. And of those three numbers, only one is immediate and unforgiving. A business with strong revenue and no cash doesn't get to explain its income statement to its creditors. A business with strong cash gets to survive long enough to fix everything else. The company that doubled its revenue and ran out of cash wasn't a failed business in the conventional sense. It wasn't badly managed in the ways most people imagine. It was a business that understood how to grow, but didn't fully understand what growth costs before the money comes in. It understood revenue. It didn't yet understand the distance between revenue and cash. And in fast-moving business conditions, that distance is where companies disappear. The next time you hear that a business is reporting record revenue, the question worth asking is quieter and less obvious. When does the money actually arrive? Because the answer to that question tells you far more about the health of the business than the revenue number does. Revenue tells you where a business has been. Cash tells you where it's going. And sometimes, the most dangerous place a business can be is exactly where it most looks like it's winning. Subscribe for more videos like this.